Hey, Brian, your mortgage insider here with an update this week on what's happening in the wide world of the Ukraine. Unfortunately, that's still the headline news. Last week, we had projections from even our White House saying that the Russians were going to invade last Wednesday. They haven't done that, but they have amassed additional troops, and uh, stock markets and bond markets are reacting. So we're going to dive into the charts on there today. So we're going to look at the S&P 500 real quick for just a matter of reference. The high point in the S&P 500 hit January the 4th, and we've been on a downward cycle. And as of yesterday closing and today closing, not closed, but still below the 10% correction range. So defined when the stock market drops 10%, they define that as a correction in the markets. Sometimes that can continue, sometimes it can rebound. With all the volatility around Russia, though, we are seeing that has a major impact on both the stock markets and hopefully the bond markets in some positive ways, if there's going to be a silver lining here. So last Wednesday, February 16th, was actually the high point in the 10-year Treasury bond. So those yields were at their high point last Wednesday, the 16th, and then they've dropped. This was right after the news coming into the weekend over the potential Russia invasion. Still not happened yet as of Wednesday, February the 23rd. The Olympics are over. There's a lot of talk just in the last day. You can see there was huge changes, and these are volatile days. But we are currently hanging out in this upper range when it comes to mortgage bonds themselves. Very similar story. These do work in reverse of the yield. So as the price is falling, the yield is rising, but we have hit this bottom. So since basically February 10th, when we saw this, what would be an increase in rates, and a lock alert came out February 10th, pretty steady through last week, waiting for some kind of news. The Federal Reserve, they are going to raise rates. That's pretty well known. So with their raising of rates coming up in March, the only reason we're not seeing worse movement or higher yields, higher interest rates right now is this question mark around Russia and Ukraine, whether or not they can stave off a disaster. Geopolitically, we'll see. But keep an eye out for that. That's going to be the next move when it comes to rates. Have a great one.